Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing PetMed stock so we can determine if it's a buy or a sell. Let's get started with the model. This is a micro cap company, 280 million market cap. They're trading at $13 a share and they have 21 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They do a really good job at generating positive free cash flow every year. Even though they don't generate a ton of revenue, they still manage to be profitable. It was highest in 2021 at 38 million. Cut in half in 2022 to 17 million. It is coming up in 2023 to 23 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty steady from 2020 to 2022. It is low in 2023, only a few $100,000. Revenue is a sales for the company. That peaks in 2021 at over 300 million. It is dropping though, 270 million in 2022. 257 million in 2023. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 624 million. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $551 million. We divide that by 21 million shares. And we get a calculated stock price of $26. They're trading at $13, so they're trading at a 49% discount. It's a strong buy according to the model. There are 11 companies in the same industry as PetMed, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They only spent $5 million in CapEx, which is higher than the median of $2 million. I don't think they have any debt, so we can't look at their debt to equity ratio. They do pay a nice dividend over 6%. The only other company in this industry that pays a dividend is Walgreens, 6.8%. They're one of the few companies that generates positive free cash flow, them and High Tide. They rank second in market cap. Walgreens is a giant, bigger than the other 10 companies combined. Their price to book is average. They have a really high PE since their earnings were pretty low in 2023. They have a really good price to free cash flow, 12.6. They do have the worst price to sales on this list, but relative to the whole market, they have a really good price to sales ratio. They do generate more revenue than the median, a lot lower than the average, and they're not growing anymore. They're detracting. Their 5-year annual revenue growth rate is negative 1%. Here's their income statement from their 10K. It's full year 2021, 2022, and 2023. A big red flag is their revenue is declining. 309 million to 273 million to 257 million. Of the 257 million of revenue, 233 million from current customers and 24 million from new customers. New order sales are customers that ordered for the first time in 2023. Nearly 91% of their orders are from recurring customers, but that is down from last year of 245 million. New orders are also down from 29 million. There's lots of attrition, lots of competition from companies like Chewy. Of the 257 million of revenue, 86% is internet revenue, people who go online to order. 14% is from their call centers. They make more money from the internet sales because you don't need a person on the line to take the order. Below revenue is cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That's also declining from 90 million to 78 million to 71 million. Their gross profit margin in 2023 is 28%. It was 29% in 2022 and 2021. Then you have general and administrative expenses, 50 million. That's up a lot from prior years. G&A expenses increased 19 million when you compare 2022 to 2023. The increase is from 6 million in payroll expenses, 2.1 million in stock-based compensation, 400,000 accrued severance, 1.9 million in professional fees, and a $1 million increase of software and systems expense. In 2023, G&A was 19% of their revenue, 11% in 2022, and the forecast for 2024 is 17%. Advertising is also up from 2022, down from 2021. It's 19.4 million. Depreciation is up to $3.5 million. Total expenses $72 million. An operating loss of $1.4 million in 2023, compared to a gain in 2021 and 2022. But they did receive $2.1 million of interest income, and also $900,000 of other. So a gain of $3 million in other income. The large increase in other income is due to higher interest rates. Taxes of $1.4 million, so they have positive net income of $200,000. Last year it was $20 million, before that $30 million. And their shares outstanding are going up a little bit. It was 20.1 million in 2021, now it's 20.3 million currently. And they paid $1.20 of dividends per share in 2023. Same as last year, it was $1.12 in 2021. Let's look at their balance sheet. They do have a lot of cash, $104 million of cash, $1.7 million of accounts receivables, $19 million of inventory, $131 million of current assets, only $36 million of current liabilities. So their current ratio is about a 3.5. Current ratio is current assets over current liabilities. $26 million of property and equipment. Here's a breakdown of the $26 million. Buildings $15 million, land $3.7 million, improvements $3.9 million, computer software $9.4 million, furniture, fixtures, and equipment $9.4 million. That's $41.4 million. They depreciated that $15 million. So the $26.2 million is what they show on their balance sheet. They have $6 million of intangibles. So their total assets, $164 million, down from $176 million. $25 million of accounts payable, so they bought on credit. They owe that money. Accrued expenses of $11 million. Then they have other long-term liabilities, $3.8 million. Total liabilities, $40 million. They raised $18 million from selling their business. They profited $105 million from running their business. So total equity, $124 million. Let's look at the statement of cash flows. The statement of cash flows has three sections: operating, investing, and financing cash flows. Even though they only had a $200,000 accounting profit in 2023, they actually generated $28 million of cash flow because they sold $13 million of inventory in 2023. It looks like they bought a lot of inventory in 2021. They had a cash outflow of $16 million, and they finally got around to selling that inventory in 2023. But it's not sustainable to sell inventory. You need to start generating a healthy profit like they did in 2022 and 2021. $200,000 just won't cut it. In their investing section, they paid $5 million for minority interest in Vetster. That's a hard word to say, Vetster. On April 19, 2022, the company engaged in a 3-year partnership with Vetster. That's a Canadian telehealth veterinarian. They also purchased a 5% minority stake for $5 million and received warrants for additional equity. Under the agreement, Vetster became the exclusive provider of telehealth and telemedicine services for this company. So they may have exclusivity in Canada. Just a few months ago in January, the company entered into an agreement and plan of merger to acquire PetCareRx. That's a leading supplier of pet medications, food, and supplies. And they paid $36 million in cash for that. When that deal is complete, PetCareRx will become a wholly owned subsidiary of this company. When you see the term wholly owned subsidiary, that means they own 100% of that company. They spent $5.3 million in property and equipment. In their financing sections, there's only dividends paid. They paid $24.5 million of dividends, similar to last year. Let's look at their fourth quarter earnings slides. Your trusted pet health expert. Vision: every pet deserves to live a long, happy, healthy life. Mission: PetMed aims to be the most trusted pet health expert by providing incredible care and services that are affordable to the broadest group of pet parents. Founded in 1996, serving over 11 million people in the United States. Company highlights: closed acquisition of PetCareRx in April 2023. Strategic initiatives in pet telemedicine. The acquisition of Vetster, and pet insurance, the acquisition of Pumpkin. Let's see what they say about Pumpkin in their 10K. In February 2023, we announced a strategic partnership with Pumpkin Insurance Services. Pumpkin is a leading provider of best-in-class pet insurance plans. We're partnering with Pumpkin to offer our customers access to high-quality health and wellness pet insurance products. This partnership will give our customers direct access to co-branded insurance products developed in conjunction with Pumpkin and their underwriters that will be offered by our new subsidiary, PetMeds Insurance. We expect that such products will become available for purchasing during fiscal year 2024. It is good to see they're acquiring companies. When you invest in a business, you want to see them grow, either organically or through acquisition or a combination. They rolled out their auto ship and save service, which is 44% of their revenue. That's a way for them to automate prescriptions, so it should improve their margins. New customer growth of 12%. Their LTV CAC is 1.9, which sounds a little low, but you want to compare this historically. LTV is a lifetime value of a customer, and CAC is the cost of acquiring that customer. So it's LTV over CAC. So just to give you an example, say it costs $100 to acquire a customer because you have to spend money on marketing, things like that. And the average customer spends $100 with your company historically. So you wouldn't be making any money. That's if the ratio is 1.0. In their case, the ratio is close to 2.0. So their customers are spending about twice as much as the cost to acquire them. Obviously, the higher the better for this ratio. It is industry specific, so certain industries will have a higher ratio than others. When they made these slides, the stock was trading at $14.72, 319 million market cap, 2023 revenue of $257 million, net income of $200,000, adjusted EBITDA of $20 million, 21 million shares outstanding, 18 million are on float. That means 3 million shares are held by insiders. They're not available for people like me and you to purchase. Total wellness from nose to tail, additional growth, transaction, and partnership opportunities. Product expansion, PetMeds and Pet Care RX. Now they have their insurance arm, Pumpkin. Integrating Pet Care RX, additional products, higher LTV, expanded distribution capabilities. Remember, LTV is not loan to value. That's a popular ratio in real estate. LTV is lifetime value of a customer. How much money the average customer spends at your business. Coordinate demand generation, expand distribution and shipping, analyze supplier agreements. Expand addressable market, increase product availability, higher LTV and wallet share. Market opportunity, a diverse opportunity for pet parents focused on diet and health. The total pet market in 2021 was $123 billion. Nobody can deny it's a huge market. Pet insurance is $10 billion, non-prescription food, $51 billion. So if you go to Costco and buy dog food, that's non-prescription food. I think this $26 billion is pet supplies. It's the same color. They don't footnote it here like they did with these other three. $35 billion is prescription medication, non-prescription medication, prescription food, and also supplements. So it's a huge market, lots of opportunity. Hence the phrase market opportunity. Growth strategy, strategic initiatives to transform PetMeds. A check for new customer growth, a check for increased recurring subscription revenue, a check for non-medication catalog expansion, a check for unique and differentiated services. Revenue growth, that's definitely not a check. Selected financials. In the first quarter of 2023, revenue of $62 million, down from $66 million. For all of 2023, revenue of $257 million, down from $273 million. They really need to figure out a way to avoid more revenue declines. Gross profit, $17.4 million, $19.4 million last year. In all of 2023, $71 million, down from $78 million in 2022. For the 3 months ending March 31st, 2023, operating expenses $24.5 million, double 2022. Not good. Higher expenses, lower revenue, margins are getting squeezed. Operating expenses in all of 2023 is $73 million, up from $52 million. Adjusted EBITDA $3.6 million, down from $9.5 million. In all of 2023, it's $20 million, down from $34 million. They had a net loss of $5.1 million. Last year, they had a gain of $6.1 million. In all of 2023, a gain of $200,000. In all of 2022, a gain of $21 million. They have $104 million of cash, so they do have a lot of cash on hand. It is down from last year of $111 million. They say improvement of business on a year-to-year basis with new and returning customers, especially in loyal returning base. I'm not sure how accurate that statement is. To improve organic growth, they're using working capital and CapEx. To improve inorganic growth, acquisitions, alliances and partnerships, and return to shareholders, dividends and share repurchases. I don't think they're doing much share repurchases, but they do pay a really nice dividend. Investment highlights: expert, well-known online pet pharmacy with over 2 million unique customers. Strong market demand for pet medication in pet category, resilient to economic headwinds. Strong balance sheet as a basis for growth with significant brand assets. Broad strategic plan, expansion of new customers, more products, unique and differentiated services. So that's the end of their PowerPoint slides. Let's look at this stock on Simply Wall Street. Its last price was $13.36, 273 million market cap, down 5% in the past week, down 39% in the past year. Let's learn about the company. PetMed Express, with its subsidiaries, operates as a pet pharmacy in the US. The company markets prescription and non-prescription pet medications, health products, and other supplies for dogs, cats, and horses. It offers non-prescription medications and supplies such as flea and tick control products, bone and joint care products, vitamins, treats, nutritional supplements, hygiene products, and supplies, and prescription medications including heartworm preventatives, flea and tick preventatives, arthritis, dermatitis, thyroid, diabetes, pain medications, heart and blood pressure, and other specialty medications, as well as generic substitutes. They also sell food, beds, crates, stairs, and other pet supplies. It sells its products through its internet website, mobile app, customer support center, and also direct mail, which includes brochures and postcards, as well as television advertising under the 1-800-PetMeds, PetCareRx, and PetMeds brands. The company was incorporated in 1996, 27 years ago, and is headquartered in Delray Beach, Florida. Here are some of the rewards on Simply Wall Street. Trading at 19% below our estimate. Earnings are forecasted to grow 89%. Well, they were so low in 2023, I hope they grow 300%. Analysts say stock will rise by 37%. Here are some of the risks. Dividends of 9% not well covered by earnings or cash flows. Large one-off items impacting financial results. Profit margins are lower than last year. Here are some of their competitors. Brilliant Earth, 382 million market cap. Big Five, 200 million. Sportsman Warehouse, 217 million. And Build-A-Bear, 301 million. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $15,000 today. That's a 53% return, a 4% annual return. But at one point, your $10,000 would have been over $40,000. If you did invest 10 years ago, you'd always be in the green. The stock was always up. It did have a big dip here, but it came right back up, although it came back down, but it's still in the green overall. And if you invested $10,000 into this company 10 years ago and did not reinvest the dividends, you'd have more. You'd have $17,000 today, because you would have taken those dividends and invested in something that gives you a higher return. Because their annual return was only 4%, it looks like the market was 5.5%, or at least the return they use on this website. It looks like the stock started trading in 1997, so it's been public for quite a while. And it had a really nice run up from 2000 to 2006. It broke through $19. Then over the next 4 years, it came down, came back up. And then in April 2010, it had its highest point ever, up to that point, $23. Then the stock did struggle, falling below $10, and it took 7 years to get back up to where it was in 2010. In 2017, it was $23. Then it hit its all-time high, almost $50 in January 2018. In 2019, it got down to $16, $37 in June 2020, but since then, its trajectory has been downhill, below $14. So if you bought the stock in 2006, 17 years ago, you'd be down about 10-15%. Although you would have gotten your dividend payment though. So you have to factor that into the equation. The nice thing about Simply Wall Street is it tracks a lot of information. All the news stories are here. Click on this button, see more updates. We could read all the news stories since December. I wonder if there's a place on the website I could look at news stories in prior years. Their latest news story on June 1st, high number of new directors. There are 5 new directors who have joined the company in the past 3 years. I'm not sure if that's a positive or negative. It may be a neutral thing. The second news story on May 30th. EPS estimates fall 31%, revenue upgraded. Here's the outlook for 2024. They increased their revenue forecast for 2024 from 300 million to 310 million. That will be huge if they hit these targets. Even if they get 300 million, that will be huge because it was only 257 million in 2023. They did break through 300 million in 2021, but it went down a lot the next 2 years. Their EPS forecast fell from 69 cents to 48 cents. Their net income forecast is to grow 4,000% because their net income was so low in 2023. It was only 233,000, their net income for 2023. Their price target is down from 1867 to 1750, and the stock price is well below that point. It fell 5.3% the past week to $15. The next news story is upcoming dividend of 30 cents, which is a yield of 8.1%. Because the stock price keeps coming down, so the yield looks more and more attractive. As the stock price goes down, the yield goes up. To be eligible to receive the 30-cent dividend, you have to buy the stock before June 5th. So if you buy it now, you won't get the dividend. Obviously, you can't get the dividend because they already paid it on June 12th. And they're paying out more than 100% of their earnings and cash flow in dividends. So they're probably going to have to cut their dividend because there's a really high yield over 8%. 2023 EPS and revenue missed analyst expectations. Revenue missed analyst estimates by 2%. The revenue is projected to grow 12% per year over the next 2 years, compared to a forecast of 6% for its industry. Over the past 3 years, EPS has fallen 35% per year, but their share price has only fallen 24% per year. Let's look at this article, Returns on Capital at PetMed Don't Inspire Confidence. If you're looking for a multi-bagger, there's a few things to keep an eye out for. First, you want to see a proven return on capital employed, and second, an expanding base of capital employed. This means that a company has profitable initiatives that it can continue to reinvest in, which is a trait of a compounding machine. However, after investigating PetMed Express, we don't think its current trends fit the mold of a multi-bagger. ROCE is a metric for evaluating how much pre-tax income a company earns on the capital invested in its business. ROCE is EBIT divided by assets minus current liabilities. So this company's ROCE is 10%, which is good, but lower than its industry average. 3 years ago, their ROCE was 23.5%, so the number's getting much worse. The company has been employing more capital without a corresponding improvement in sales, which could suggest these investments are longer-term plays. At least that's the hope, because if they're spending money, if they're investing, and their revenue is going down, then what's the point? Why invest at all? You want to see a return on your investment. In summary, PetMed Express is reinvesting funds back into the business for growth, but sales have not increased much yet. The stock has declined 51% over the past 5 years, so that means investors are not too optimistic about this trend improving. We do not think PetMed Express has the makings of a multi-bagger. In the past week, this stock is down 5%, its industry up 1%, the market up 1.1%. In the past 30 days, this stock is down 13%. In the past 90 days, down 13%. In the past year, down 39%, whilst the industry and the market are up. And in the past 3 years and 5 years, down over 60%. So this could be a great time to get in, or maybe the market is right, this stock is doomed. We just need to figure that out. Their 2023 revenue is $257 million. The cost of revenue is $185 million. So the leftover revenue is the gross profit, $71 million. Expenses of $70.8 million. So there's only $233,000 left over for profit. Their EPS is only 1 penny, gross margin 28%, net margin 0.1%. And it looks like they're debt-free. They have a 0% debt-to-equity ratio. Here's a different way to look at it. Of the $257 million of revenue, cost of revenue $186 million, and that's a big chunk. Then a thin chunk is $71 million, the gross profit. Of that $71 million, $70.8 million went towards expenses, and these are all the expenses. G&A, SG&A, depreciation, non-operating expenses, and other. They pay a really nice dividend because the stock went down even more the past day. It's at 9%. They pay out 10,000% of their net income because their net income was so tiny. Their price to sales is worse than their peers. Build-A-Bear is 0.6. Look at some of these price to sales ratios, 0.2, 0.2, 0.1. It's like they're just giving money away. Here's their price to sales since 2018. It was 2.4, then in 2019, 1.1, then it went up to 2.4 in 2020, now it's 1.3. Price to book has a similar trend. In 2018, 5.2, then it's 2.5 in 2019, up to 5.4 in 2020, now it's 2.7. Simply Wall Street's valuation is $16. They say the stock is 19% undervalued. 3 analysts priced the stock and the average price target is 18. They say the stock is 39% undervalued. The revenue is forecasted to grow over the next few years. It's currently $257 million. In 2024, $308 million. In 2025, $332 million. If it does hit these levels, the stock will go up a lot. In 2012, their trailing 12-month revenue was $230 million. And then it was pretty steady for about 5-6 years. It took until 2018 to have a nice growth. It was up to $286 million. Then it declined a little bit into 2019. It had its highest point ever at the end of 2020, $312 million. I guess lots of people stuck at home going through telehealth companies instead of driving to the vet or going to a brick and mortar store. And it looks like they're always debt free. They don't have any debt. And their equity seems to be going up overall. Its highest point was $142 million. It's currently $124 million. In 2012, they were paying 60 cents per share in dividends. It jumped up to $1 in 2018, and the forecast is for them to pay $1.45 by 2025. So if you buy the stock now and it does get up to these levels, $1.45, you'll have a yield of like 15%. And here's the dividend yield since 2012. It was 6%. It got down to 1.6% in 2017 because the stock price started rising. And then the stock price started coming down, so the yield went up to 6.5%. Then it went down in 2020, and then as the stock started crashing, the yield started increasing. It's almost 9% now, and the forecast is for the yield to hit 11% by 2025. The CEO's salary is $500,000. His tenure as CEO has been 2 years. 85% of the company is held by institutions, 10% by the general public, and 5% by individuals. BlackRock is the biggest shareholder at 17%. They own 3.5 million shares. Then Vanguard, State Street, Renaissance, Murray Asset, Dimensional, Citadel. The CEO has 3% of the company. A positive sign is seeing employee count going up. It was 206 in 2013. They're up to 302 currently. And the stock trades on the NASDAQ and Deutsche Börse. So let me know what you think of the video. Leave a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.